Friends, in this video for I Thought Wealth, I am going to talk to you on the topic the 5-year test. What do I mean by the 5-year test? When we try to ideate investment ideas, often we are trying to see how the next year will be. So you will see a lot of people saying that, look at this company, it's in this BOPP or in this API or in pharma or in this platform which is doing so much business this year, but there will be a significant bump next year which will raise the earnings substantially. The company is trading at a relatively low PE ratio today, and when the company sees higher numbers next year, both the profits and the PE have to expand significantly. When somebody tells you this, what do you think? Intuitively, you're made to be attracted towards such an idea because you're seeing something happen immediately in a consequent year or a subsequent year, and you naturally think that this will continue for the next 3 years. I've seen this happen in multiple situations the last 2 years. People give a PE as if it's a natural right to a company which performs significantly in 1 year, and that improvement shown over the previous year is relatively very significant. So you think that the PE ratio is a given. PE ratios of many companies expanded simply because you saw this contrast between 1 year and the other. But when you look at that company after 1 more year or 2 more years, you suddenly see only headwinds, right? So if you are one of those investors who bought after the PE ratio got expanded, thinking that there's going to be 1 more similar year or 2 more similar years, you may actually be staring at losses. So even though the company may be a decent company, you start making losses. Also, you're not going in the direction of winning in your investing. Then you have to run back to where you began. You have to sell, exit, and then find the next idea where you see this relative outperformance, YOY. For many investors, almost the first decade of their investment career is spent only looking at this YOI shifts, changes, so that they are early in that game and they find people who are late who will buy those companies. You'll see this happen in sectors like paper, chemicals, in number of commodities, people buying early and then justifying a PE expansion to those who listen to them, to their followers. But as an investor, even for these people, this won't take them to where they want to be. Someday, they are going to fall under the weight of their own way of working. What worked for me after 2 decades of investing was something very different. I felt that only businesses which had sustainable performance for 5 years and beyond created significant wealth for me, while these kind of companies were more like trading sardines. And these trading sardines took a lot more of your bandwidth, time, energy, and mental attention. So you're actually giving more time to all this than to the company which will do very well over 5 years. And interestingly, a company which will do very well over 5 years will do very well for very long periods of time, not just 5 years. So your compounding would happen for a very long period of time without your having to pay taxes, find ideas to replace bets, run replacement risks and reinvestment risks, and actually you had a lot more time to yourself. So actually investing became easier when you gave up looking for near-term success and trading sardines. Culturally also your mind goes through a very big shift. For me personally, it helped me to think about how you can buy businesses in private entities which are not even listed, which means we could possibly think of a listing after 5 to 7 years, and we could think of selling after 7 to 10 years, somewhere in that zone. No timelines basically. You start thinking like a business owner and you're ready to own the business for a long period of time. There will be phases like 2017 to 21 where you didn't really get that visibility. Even businesses which are very strong tend to become treated like trading sardines like the market. I would give the amine stocks like that. They look very strong, but they were then treated like trading sardines, and today they are seeing a downward correction in their business fortunes. So that's really an aberrative phase. Those 4-5 years have been very different and I would say not very easy either for this style of investing. But the next 5 could be very different. When the economy goes in a relatively stable phase of growth, we could start seeing businesses more clearly, our visibility could improve, and the markets may lose patience. That's a nice triangulation. Better visibility, markets losing patience, and business fortunes improving. In that triangle, we will find businesses that we can own for 5 years and beyond. So whether you are an individual investor or an advisor or a portfolio manager, I think that the times that we are heading into will give us those 10, 15 ideas which we can hold for a very long spell without worrying about selling, reinvesting and replacement. But the mindset has to be generated consistently. You can't suddenly say that I'm going to stop doing that, I'm going to do this. You need to make a lot of effort, you need to dig into your past experiences, you need to take away a lot of biases in your head, send them out and then create space for freshness and learning from your success, both. Those two have to kind of gel together. You need fresh thinking and you need to learn from what really worked for you and you need to meld those two together into an investment approach. I think the next 5 years are going to demand that of every one of us, and the 5-year test should help us own better businesses for longer periods of time with lower replacement and lesser reinvestment. Importantly, the journey would be with superior returns. Thank you for watching this video.